Well, the market sentiment seems cloudy right now. Our next guest says clear skies ahead. We're going to get better inflation, lower interest rates, and generally a better market environment. David Dietze is senior investment strategist at Peapack Private Wealth. David, from your lips, I guess we are going to see these clear skies right now. Where are you getting the confidence that sees that kind of better macro environment? I mean, low inflation, low rates, that's everything the market could hope for.
Yeah, absolutely. So I think there's a number of factors which have been headwinds in investors' faces, which could actually turn into tailwinds. I think the most important factor really is inflation. Certainly, if you go back a year where we were in the high single digits of year-over-year price increases, now, of course, we're well below 5% year-over-year. So we're certainly moving in the right direction. We heard some valuable so-called personal consumption expenditure inflation data this morning. It seemed to continue that theme. I think the headline was what investors were expecting. The core, when you strip out the food and energy, was a little bit better. So we're moving in the right direction. Why is that so important? Because ultimately, inflation is what causes bond investors to demand more money. That's what causes the Fed to raise hikes to cool the economy, to quell that inflation. And with inflation continuing to come down, we think that we're going to be looking for a less hawkish Federal Reserve going forward. And who knows, we may be very near the end of this massive interest rate environment hike, and we could be backing off a little bit next year, which would be manna from heaven for equity investors.
You know, I want to talk about that because investors are nervous right now. When you look at gauges like the VIX, when you look at the AAII view from the bears, bearish sentiment is at the highest level since May of this year. So we're nervous, but I'm hearing a lot of strategists like yourself point to 2024 and say, it could be that the peak was in for the U.S. 10-year yield. You could see it come down to maybe 3% yield from, where we are around 5%. I mean, does that not set yourself up for, what they call like a rip your face off rally in equities?
I don't know about a rip your face off rally. I like the way you think, however. But look, this country has never seen 3 down years in a row, even adding back income on the bond market going back to the 1700s. So we already had 2 disastrous years. We are now still down for the year. So certainly the probabilities are that things get a little bit better here. We do need to look for signs for cooling in the economy. If we see signs of cooling in the economy, that's going to take some of the pressure off of interest rates here. I mean, right now our problem is that every day people are saying, what's my yield on stocks? What's my earnings yield on stocks? That's my yield on bonds. Bonds have been looking so attractive. It comes down to people saying, hey, Dave, why do the stock thing when I can get over 5% on a treasury? But once those things start to come down, yeah, there will be the rotation back into the equities.
Okay, so are you going to hunt for yield then? Because those high yielding stocks have been the worst performers so far this year. And if you are going to hunt for yield, where are you going to go shopping?
Yeah, absolutely. So, I was just looking at the various factors that have driven various groups' performance, and the worst factor for this year to date, has been high dividend yield. Those stocks are down 10%, and we know, for example, the S&P 500 is up about 8%, and the Nasdaq's even higher. But these things are cyclical, okay? When you have in 2022, dividend yield outperformed the Nasdaq, for example. And so what we'd like to see best is an above average dividend yield, but one where we think it can grow, because historically it's not just the size of your payout, but the ability to grow it over the years. So, one very good screen for investors is really the so-called dividend aristocrats. What are those? Aristocrats means they've increased that dividend not just once or twice, 25 years in a row. That shows you the mindset of management. That shows the strength of the franchise. That's a good spot to do some research.
Okay, we're going to get to some of those top ideas in the next segment. But one of the sectors that could be ripe for this kind of investing style is the financials. There's so many headwinds. for these bank stocks. It looks like you're nipping away here. What's your top idea in the space?
So, we're looking at Truist Financial. Truist Financial is the product of a merger between SunTrust and BB&T down in North Carolina. That's a faster growing, lower cost area of the country. And as a result of that, that propelled them into the top 10 banks in this country. We saw by how policymakers acted in March, there is absolutely no appetite to let any of those larger banks fail, as it were. Other than lowering benchmark interest rates, they practically did everything possible with discount windows, with basically wink and a nod telling all depositors, whether they were insured or not, that they would be covered, as it were. And so we just need to get through this rough patch. Right now, we've got this inverted yield curve, which puts banking business models upside down. Usually they borrow at a low rate, they lend at a higher rate, they make the difference. Right now, of course, it's inverted. We think as the economy continues to cool, the Federal Reserve will reduce those shorter term rates, and that will restore and rejuvenate the net interest margin. Meanwhile, of course, you've got Truist yielding close to 7%.
And it's sustainable?
When we look at so that's the question. We think it is. We think in terms of when you look at the payout versus what they're likely to earn next year, we think it is sustainable. They're also just at 2/3 of book value. So both of those, that above average dividend yield, that big discount to book value, given you got a franchise bank there, I think are good indicators that you could outperform the market in the next 12 months.
Okay.